What's up, YouTube? It's Joe Catchpollia sitting on the couch making some money investing in fractional real estate online, as usual. Today what I'm going to do is take a look at the Arrive secondary market, share a different way that I've been sorting these and looking at things. There's a lot of properties, right? It's a lot to tackle. Figuring out which ones to focus on during each secondary market is going to be a challenge, I think. There is a tool that's going to hopefully be available soon that I have a little preview of, so hopefully I can talk about that coming up in not too long, maybe not till the next one opens. I'm not really sure. Probably should not even mention it, but anyway. So until then, I've been trying to figure out, okay, what's the best way for me to dig into these to identify potential properties. And then also, it's right this time there's 454 properties available. I'm really only going to try to identify a few, do my due diligence on those, and then see if I can make a deal. I'm going to talk a little bit about how I'm doing that. Before I forget, please like and subscribe. In the description of this video, I have links to all the places where I'm currently investing in fractional real estate online. Please do your own due diligence on those platforms and any properties that I talk about. Just because I'm investing in them doesn't mean it's the right answer for you. I'm just sharing my experience with these platforms, how it's working for me, how I'm thinking about it as a real estate investor who's been in the industry for 20 plus years. But it doesn't mean that just because I like something that it's the right answer for you. I've already shared quite a few losses that I've had on multiple platforms. So it's certainly going to happen. Overall, I'm pretty happy with my returns in fractional real estate, but I think there's definitely some work that needs to be done to get to get better returns than I have. With that in mind, please also take a look in the description of this video. There's a link to the Discord channel I have set up, where I'm just trying to create a community of us. There are around 270 at this point people who have joined. A lot of you are lurkers, but there's a lot of people who are asking questions, sharing info, sharing some due diligence, talking about their experience on different platforms. And so please feel free to join that. There is no cost to be to join that Discord channel. It's not a sales funnel. I don't DM you trying to sell you anything. The closest thing to spam that I allow on there is I post links to my newer YouTube videos in the channels where they're applicable. Try not to ping people too much. But there are people, when you join, that might look like me that are trying to scam you and send you a DM and asking for money. I'm never going to try to get you to invest in anything, sell you a course, any of that through the DMs. I'm not doing it at all. But if you are getting DMs like that, please report that person. It is an imposter. Okay, back to what we're doing here. So, what am I doing differently? In the past, I've been trying to look at the Arrive valuation, and then when the market is open, you can sort it by this is the average open sell order, the discount or premium to the average order open sell order. No, what that averages to the Arrive valuation. I'm not really sure why they do the average, because what's important to me is whatever ones are available, right? Not what the average is. So I think it's a little bit strange, but that's how I've been looking at this before. This time around, I decided, hey, let me take a look at which properties have the most shares listed. Because if we're trying to look for good deals, what we need is an imbalance between supply and demand, right? Like real estate in general, a lot of the profit that we make comes from the fact that it's an inefficient market. And that there are at certain times large imbalances because of a lot of different reasons. There's imbalances in in information but also in like liquidity and demand at different times of year and different locations. But so one of the things that I think is going to indicate that we might have a chance to make or invest in something at a really good deal is that there's a lot of shares listed. And so this is, I started looking at it from the top down of, okay, which properties have the most shares listed at the moment. And, some of them have a lot listed, but they're listed significantly above the arrived valuation. And then I came across this one, and there's actually quite a few like that, right? The red bar basically shows you, the line is the arrived valuation. The red bar shows you shares that are listed for sale. And so the first one that I came across that I thought, hey, that's pretty interesting, is the June, right? This has 3,845 shares listed for sale. That's out of about, how many were there total? I think there were in total, let's see if we can find it. I think, yeah, 66,000. So what did I say? 66,789. And there are 3,845 listed. 3,845 divided by 66,789. Yeah, so almost 6%, 5.75% of the shares that are owned are up for sale. I mean, that seems like there's somebody's trying to sell a large block, or a lot of people are trying to get out of this property. And so you can see at the moment there are very few buy orders, right? And so I think over the next week, as this market is open, if these people are serious about selling, we might see this number creep down a little bit, right? Like if I finish my due diligence and decide that I want to try to buy some of this, I think I'll probably do what these people are doing, is put in a buy order somewhere below this 685, because I think there's not, these aren't getting bought up right away, and the fact that they already listed it at a pretty deep discount to the arrived valuation makes me think that these people are motivated to sell these. Now, whether this is one person listing all of those, or it's several people that have just decided to match that price, I don't know. But so, okay, let's look at this property and see. I'm gonna do just like I would on a normal due diligence video, because this is one I think is pretty interesting, and I want to figure out, okay, is it for me or not? So where do we get started? It's a 3-bedroom, 3-bathroom home, built in 2021. It's just over 2,000 square feet. It is a long-term rental. We can see it hasn't been performing very well, right? Like, the yield at the arrived valuation has averaged 3% over. I think when they do this yield, it's the average of the prior year, or the trailing 12 months average, I believe. I'm not 100% sure about that. But when I was looking at the dividends and doing the math, that's what it looks like to me, is how they're coming up with that. I think actually the average dividend paid for this property over the last 12 months. Yeah, so that average dividend yield relative to their valuation. It's important to understand whenever we're looking at this what we're really talking about, right? And you can see their valuation is a pretty big discount from the $10 that it originally came to the platform for. So I think like at $10, if you look at the dividend yield, it was like 2.2% or something. So one of the things I do is I click on the performance, view full performance, and you can see, okay, the most recent dividend paid 2.22%, but that's based on a $10 per share value, right? Well, we're not paying $10 per share. We're also not planning to pay this $862, right? This $685 is basically a 20% discount from arrived's value, and so then we get a higher yield because we're paying less, right? And when I did the math on it, it was like 6.7% yield, which is still not fantastic, but it's it's significantly better than the 2.22 that anybody who paid $10 per share for it. So a couple of things I want to try to figure out, like, okay, first of all, I'm going to look at the market a little bit. Is this the market I want to be in? But then, do I agree with Arrive's valuation? Is the price that we're paying really a discount to what I think the real world value is? But a couple of things I wanted to point out. This lease did just renew at $2,845 for 10 months. It had been a 15-month lease originally, but the lease rate before, let's see if we can find it. Oh, okay, now I'm just going to zoom past it somehow. Okay, my computer's acting a little silly. It's a little laggy. So it was $2,695, right? And so what did I say? 2,845. So it's gone up. What is that? $150? Yeah, I think it's gone up $150. And one of the things that people don't necessarily think about, they think about, okay, $150 relative to $2,600 isn't that much. But a lot of the expenses are relatively fixed. Now, our management fee is going to be a percentage, right? So they're going to take a percent of the higher number. But like our property taxes didn't necessarily go up, and if it would be interesting to see, but in a lot of places, property taxes have actually gone down over the last year because values have gone down, especially if owners are doing the right thing and protesting taxes. I don't know if Arrive's doing that or not, but so I think that more of the rent should go to the bottom line than you might expect is really all that I'm saying there. Now, it was built in 2021. We're passing, or we're in the 5th year of the property being in existence. We're going to start to see, if I buy this today over my hold period over the next few years, I'd expect the beginnings of some of the bigger capital expenditure type of items to pop up. I mean, obviously, I think the roof and the HVAC should be good for a while. But things like water heaters often only last 7 years. That's the next kind of chunky thing. But also too, just like paint and flooring, you might have gotten away with touching stuff up and doing repairs. But depending on how people use it as a rental, the next time we have a turn, it might be a little bit more expensive than the last one. Or the property might not look as fresh and new, and it might be tougher to rent. Oh, and that's one of the things I wanted to point out. So it had been rented for $26.95, but it was originally rented for over $3,000, and this is probably lease started $3,320. This is in my opinion, and this is over their forecast by $125 in this time period. In my market, and I think a lot of other markets, people started to see pretty big jumps in lease rates. And in often properties that leased for a good amount in that time period actually backtracked and lost a good, the next time it rented for cheaper. I think that's probably what was going on here as the market rate changed. But I also think it was almost a brand new home that first time it rented. The next time, not so much, right? It's a few years old. And I know that seems like, I've mentioned this a few times lately, and some people think that seems crazy, right? Especially if you're like me and you grew up somewhere like the Northeast where, everybody lives in a 100-year-old home or older, right? There just aren't all these new homes around. But it is something that, especially in markets where there is a lot of new construction, a lot of times those brand new homes just lease a little better. Either they lease up faster or for more money. And so I'm not sure which is going on, but I think I would expect going forward the yield to be higher than it was over the last year, just because our lease rate went up, right? So I think that's a good thing. I wanted to dig into, Nashville, it's a market that has been rapidly growing, right? Like the city itself, you can see really strong growth trends, population-wise, right? Which is always what I'm looking for as the best indicator of the demand side of residential real estate, right? Is, how's the population growing? It is obviously a market that has a decent amount of new construction still, and just like my market here in Texas, that makes it so even though the demand is growing really fast, supply it might not quite keep up, but it's not it's not the same as if you had a supply constrained market and you had that same population growth. That's what I want to point that out, because even though this is the metropolitan statistical area for Nashville, and you can see it's growing even faster than the city itself, right? It's almost double the rate of that. Well, I mean, it was pretty strong here, but definitely faster than the rate of the city itself. So that's one of the things we are in the city, right? We're not in the suburbs, but it appears that maybe the suburbs are growing at a faster rate. Something to think about. Looking at the home price trends, over the last year, prices went down 3.9%. This is actually, I've noticed this in a bunch of these charts that I pulled up today, is they seem much less smooth. I don't know if they did something with their chart that they're, or the data that they're getting, but, this doesn't look necessarily like the familiar shape that we've seen. But when I looked at a couple other markets today, it looked like this too. So I think that they're just, it's more granular. They're not smoothing this curve as much. But this is basically, you were still seeing basically the same thing, right? We saw a peak in 2022 and a little dip, and then some markets saw a little bit of a rise, and this one seems to. But then, okay, we're on a decline again, and it doesn't look as though it leveled off. And Zillow doesn't think it has, right? It still thinks over the next year we might see a little bit more of a decline. In the long run, it's a market I think should do well. But yeah, I think probably because look at this line, right? It looks like it went basically straight up. If we go 5 years back or just before this was built, we were, prices were much, much lower. So it's interesting to see that. But overall, it's a market that I'd like to be in long term. Let's get rid of that. Looked at the flood map. And one of the things, the flood map looks like there are less properties when that flood map picture was taken. I guess it's not so obvious from this picture, but it looked like it when I started to pull the map around a little bit. This one's 2024. Maybe I was looking. Obviously not, right? This is not newer than this one. I wonder what I was looking at. It might have been one of the other properties where I noticed that. That's one of the reasons that you do your own due diligence, right? And like you dig, just because I say something on here doesn't mean it's a fact. You want to dig into it, see, verify that that's true. Because clearly I'm confusing this one with another property when I say that. But in general, this is our address though. I like the flood map, right? It looks like we're just in a unshaded X, which is what I want to be in. Oh, although is it just not loading? Oh, there we go. Okay. Sometimes these don't load right away. And so I never just look at these. I always move it around until I find a floodplain that loads, because that's the only way to know for sure that they have actually loaded. So that's a little scary sometimes. I also wanted to look at the crime map. This is only a few days of crime showed up, but they pulled a pretty wide area. So yes, all this crime happened in a few days, but when you zoom into our actual neighborhood, we saw none right here, and then you have to go over, the next little subdivision over basically is where you see some for the first time. Now, again, this is only pulling a few days of crime. Now, I haven't been pulling it up as much lately. I think the Neighborhood Scout is another good way to see like heat maps for crime statistics. But overall, I was pretty happy with this. The other thing that I like to do is just use this and zoom around and see, is there a lot of graffiti? Does it look like there's broken windows? Do you see a lot of broken down cars or trash just thrown in the road? And actually, one of the things I wanted to point out about this, it does look like this car is maybe, and this is right across the street from us. It looks like this one might just be stuck here. I don't remember what made me think that about it, other than just how far up it is. Like it's on the, oh yeah, see, when you look at it from this side, it looks like maybe it's just stuck there. But one of the things that I've run into this quite a bit before is when you have a really steep driveway like this, it's much harder to rent this home. This home ends up being tougher to rent, and people don't stay in them as long because it's just kind of a pain to pull in and out of a driveway that's that steep. A lot of times, depending on what kind of car you drive, it can, can bottom out basically, like the front of your car scrapes against it when you go up there. And so a lot of people just end up not using their driveway when they have such a steep driveway. So I don't love that house is right across the street from our house, because, anytime that you have a property that maybe is going to be vacant more often, maybe it's going to have more turnover, you can see, there's broken blinds there. Like, this is probably going to be one of the least desirable homes on this street. There are some others that have that steep driveway, but that looked like it was really one of the worst ones. And yes, you could just park on the street and walk up there, but it just makes it so people are a little bit less likely to want to rent it. You see, we don't have that problem here. It looks like it is in at least, this is a 2025 picture. The home still looks pretty new in that picture. It is 4 years old at that point, but it's good to see, especially with some of the cheaper new construction that you see. Sometimes it starts to look faded and tired pretty quickly. And this is not like a marketing photo. This is just a Google, street view where they took this image last year. All right, let's see. Didn't really have anything I wanted to say about that one. And yeah, let's jump into, so Zestimate wise, this estimate is 588,000. At this arrived valuation, so there's arrived is basically saying it's 862 times the 66,789 shares, saying it's worth about 575,000. Okay, this estimate's a little bit higher than that. We've got Realtor has a much lower estimate, right? 500,000. And then Redfin has it at 559. So, or is that right? Yeah, that's where they have it down here. I don't know why they put it in so many different spots, but then they have a pretty wide range. I think this was purchased at 585 when Arrived originally bought it. So they're basically saying it's gone down in value a little bit since they bought it, which I think is sold for 585. So, I think they're, in general, when I've been looking at these, it seems like Arrived is being pretty honest about what their valuation is. And so, and also, if you think about it, I'm taking that property value and I'm multiplying it just by the total shares. And so they're basically acknowledging that, like, when we bought this, that they raised $667,000 for a $585,000 purchase. But they're not giving any credit to the fact that all of these expenses had to be paid to buy it, right? They're just saying, okay, well, today it's worth about $575,000. I don't know. I think that I appreciate the way they're doing this valuation. This seems pretty honest to me relative to what we're seeing on a lot of other platforms. And then, okay, so let's do the same math, though, with what it's, the 685, right? Right now, there's a ton of shares at 685. We could buy these. Times 66,789. So we're essentially buying the property for $457,000 when we buy them at this 685 price. Well, even if we look at Realtor, which is the lowest estimate, we're still getting a, what did I say? 457. We're still getting, $42,500 discount from the lowest of the estimated values, which is almost a 10% discount from this, right? I mean, I guess it's around 8.5%. I don't know, somewhere around there. That sounds, that seems. Oh, let me close this one here. That seems like pretty. And if it is, if the 588 is right, then we're getting, let's do that, right? Let's do the math on that. So this, minus 588,300. Okay, that's the difference we have. Let's get rid of that, and then divide this by 588,300. That's it. So we're at 685. We're getting a 22% discount to the current Zestimate, right? which is slightly different than the arrived valuation, but pretty close. So, maybe we're getting a 20% discount. I think from their valuation, this number is actually a 20% discount. That's, in my mind, if we can buy something that we could sell tomorrow for 20% more, even after agent fees and the money that arrived is going to take out of it and everything, I would expect us to do, not amazing, but okay, right? There's anytime I can buy real estate for less than it's worth, I'm pretty excited about it. And if it's in a market that I want to buy in and it's rented and I'm getting some yield, not a great yield, I think it's a pretty interesting deal. I think it's one that I'll follow. Oh, I also dug into the rent a little bit, right? We know it was rented for, $26.95, I think. And then it was rented for like $3,300, and then $26.95, and now $28.45. I think that's the numbers. Starts to get $26.95. As I look at so many of these, they do sort of run together. But so $26.95, and now $28.45. $28.45. How does that compare to, okay, what's the actual market rates? Well, and actually, first of all, I wanted to look at, okay, this is the last time it was listed for rent. Whoever is listing them, they're doing, they list it for rent, and then they just do listed removed. Where in my market, you'd actually see this, okay, rented, but this corresponds pretty much with when they rented it. And then you can see, okay, the next time it was listed for rent in 2024, they started it off higher than it was originally, and then they had to drop it and drop it and drop it. So it took a long time, and I'm guessing this long period of time where they weren't receiving dividends, this has something to do with the motivation for people that own this one to sell it. But then you can see, okay, once it got to this price, it actually leased pretty quickly, right? So, it's a market that's clearly just price sensitive. They had $100 drop, and then 2 weeks later, it at least in, November is not the best time of year, or October, November. This is not typically a great time to have a property for lease. And I think they did a 15-month lease initially, and now they just did a 10-month extension. But, I think if we try to redo it at this price or at the new, 28 price, I'm expecting it will lease faster, but, who knows? But so, okay, how does that number compare to the marketplace? Well, I just used the Zillow rental trends for this zip code. Just put in 3-bedroom houses in this zip code, and the average is 2550. So we're looking at a bit above average. I think it makes sense when I look at this home, right? The home itself is just not what you'd normally expect for a rental, at least not in a lot of markets, right? It's 2,000 square feet. It's 3 bedrooms. It's actually 3 bedrooms, 2.5 baths. Yeah. It's not just like, this is not the lowest end type homes that a lot of people buy to use as rentals. It's a little bit nicer of a home. So I expect, I'm not surprised that we're a little bit over this 2550. And then you can see, this is the range. They go all the way up, to over 5,000. But you have quite a few in this price range. So it seems to me that that's pretty reasonable. I also just used Rentometer. And, I think I've mentioned this before, but I wanted to say this again because I use a lot of these tools because I don't have any better way of figuring things out in this market. When I'm looking at properties in my market, I never use either of these because, first of all, looking just by zip code is often really, it's too big of an area because, rental rates in one neighborhood might be very different than they are just the next neighborhood over. So, I look at these just to sort of get a sense. But, they're not extremely reliable tools, unfortunately. Like it is, I'm sure that it's good data, but it's not granular enough for me to know, okay, this really should be renting for this amount. But it's a good, it's a good way for me to verify that, okay, the number they're saying it rented for, it's not like they just rented it to their brother at a high price so that I'd buy it, right? Like, that's one of the things that you always have to worry about when you have properties that have a tenant in them. But yeah, when I'm looking at properties in my market, I'm always actually pulling up rental listings in the same, in the same subdivision versus just in the zip code, because you just have to get a much tighter search to get numbers that are pretty reliable. Anyway, that being said, in the zip code rentometer for 3 bedrooms, and this says 1.5 baths or more homes, you can't actually pick 2.5 baths. Oh, and I actually put the address in here, not just the zip code. So it's, but it's giving you a pretty large search, right? 1.5 mile radius. They're saying the average is 2770. Well, that's a lot closer to what we're doing. And the median, we're basically between the average and the median. So I think that that's a good indication that the rental rate that they're getting is the market rate. So, next time it comes up for rent, it'll make sense, it provided the rental market's similar to the way it is now, we should do all right. So overall, am I going to buy this one, right? I think I'm buying it at $685. It looks like there's the potential to get maybe a 20% discount from the real world value. The yield at that price is somewhere, it's under 4% still. I think it was 3.7. It might be, well, let's do that real quick. And this is how I'm figuring that out. And this is not exact, right? But I just take the 8.62, I multiply it by the 0.03%, and then I divide that by the 6.85, and yeah, 3.77%. Again, not a great yield, right? Like, this is very similar to the deal that I bought on ARC 7. I'm expecting on these types of deals to be making more money from the fact that I bought it at a discount than I am from the cash flow from the property, right? If my goal is to just get a high yield, this is not the right property for me. If I want to get a property in, a fast-growing market, a market that I think has a lot of future potential, buy the property at a pretty deep discount to what I believe the real world value is, and then and this is an all cash transaction too, right? This is not there's no debt on this property, and so it's an unlevered yield, and that's one of the things to think about too, right? It's a long-term rental, unlevered. So like when you compare this to, say, for example, a pad split on Mogul, the risk profile is much different, right? We're not using the leverage, and we aren't using, and it's not a business model that has as much business plan risk. At long-term rentals, I would consider a less risky business plan than a pad split. And so when I think of those things, okay, yes, it's a significantly lower yield, but if I'm getting it plus, in addition to the discount, which is going to turn into, additional return when we sell the property, some portion of my portfolio I've decided is going to be deals like this. But because there are so many shares for sale at this cheap price, what I'm going to do is I'm going to put in an order at a lower price. Monday morning, all these initial ones, I think. Oh wait, do we? Yeah, I mean, there's a whole, like, even if all of these sold, it doesn't even touch these, But there's only 65 shares that are being purchased at this price, right? So there'll still be 2,400 available from this person if they want to sell them. They're going to have to start taking some of these lower prices that are out there. And so initially, at least, I'll try putting an even deeper discounted order in. As the week goes by, if some of those sell, and I think that there's, I don't know, I have to reassess, and I'm obviously going to look at some of the other deals that are available too. But that's one of the reasons why I decided to look at these deals this way, because in the past, I've done a lot of due diligence. I've been interested in some of these, and then there's so few shares available at the really deep discount that it doesn't really make sense for me to buy the next ones. And end up missing them. So having ones where there's a lot of available shares, sure, I think it'll work in our favor, right? I think there might be some downward pressure on this price, and even if they're not, I mean, it's not an amazing deal to me at this price, but it is. I mean, if I believe the real world value is somewhere close to, the 580, getting a 20% discount is amazing. If it's really closer to the 500, well, then I'm getting less than a 10% discount. But that's still not terrible, right? It's just not fantastic. And then, and then we're counting on some appreciation in the future, but also just when we sell it, capturing some of that discount as profit, basically. Anyway, that's all I've got to say about this one. Curious if anybody else has looked at this, if they're interested in this property, if you've seen reasons why you might not want to invest in this one. I mean, obviously, there's lots of other items that we could look at to really try to understand what's going on with the property, the market, all that sort of thing. So if anybody has any other reasons why I shouldn't buy this one, definitely share that. And if there's other properties that you think are particularly interesting this time, and obviously, again, you want to share. I know you don't want to share ones where there's 100 shares listed and you're going to try to jump on them. But some of the ones that have thousands listed, I think I think that we can collaborate and share info, and we're not at too much risk. I mean, let's say, how many, like if there's 2,400 at like $6. I mean, maybe someone swoops in and buys $14,000 worth of it. But for me, right, I'm going for pretty wide diversification in my fractional real estate portfolio. So I'll probably only buy, a few $100 worth, $500 worth, because this is another one of the platforms that I believe is just going to give me a consolidated report each year. And so I don't, I can buy as many properties as I want and not have some cumbersome paperwork at tax time. Anyway, I think that's it for me for today. Until next time, I'm going to just keep making mistakes so that you don't have to.